So I'd like to welcome you to the webinar today, which has got a really intriguing title, Yikes, insurance increases up to 50% coming your way. So Joe Tonetti and I, both senior advisors at WealthMed, we want to share with you a few insights into this really tricky thing that's happening. And many of you will start to receive letters in the mail. So we thought it was important to give you some context. So we've got some really good tips to share, and Joe and I will just jump in and hopefully shed some light on it for you.
Wonderful. Thanks, Carolyn.
So I guess with all the changes that have been happening in the insurance space, some of it has landed in the media. And so you might have seen some articles. And I think it's important for us to understand why this is happening and what options you have if you find these premium increases do come your way in the mail. It's not all doom and gloom. There are things that we can do, but there are definitely some traps to watch out for. And a lot of clients might say, well, maybe I should just dump these guys and get another insurer. Well, there are a few things to consider. It might be a valid strategy, but we do need to look very carefully before we do actually ditch one insurer and look for another. So we'll cover a couple of little things on that front as well. So, Joe, maybe you could talk a little bit about, what's happening.
Sure. So as Carolyn mentioned, post Royal Commission and a really good hard look into the insurance and financial advice industry as a whole, it's become apparent that we need to, for sustainability of insurance in Australia, that some work needed to be done. And that impacts different insurance companies and our clients in different ways. So, for example, we are fully licensed insurance brokers, so we have access to the full market of product insurance providers in Australia. So it's not just one, but the impacts are quite different. So, for example, a lot of our clients have BT life insurance, and we know already that their increases in premiums will be between 15 to 38%. Astron Life increases of 16.7%. Clearview increases estimated to be 10 and 35%, and OnePath between 12.5% and 25%. So you can see there's quite a variance across the different providers and their books as to what the known increases will be. So there's plenty more yet to announce their approach to this sustainability concern, and more information to come. So I think this is where the value of advice, Carolyn, really comes in, and what's applicable to you and what's available is up to us, to help you navigate that.
Yeah, that's good point there. And look, we've just listed a few of the insurance companies there on the screen. There's a number who haven't actually come out and said what they're doing yet, which will be a little tricky. And look, this is really coming about as a result of the government regulation flowing on from the Royal Commission, as Joe mentioned, but there's been over $3.4 billion in losses in the last 5 years on income protection insurance. It's important to note we're talking about income protection insurance. However, some of the insurers are increasing other policies as well, not just income protection. But our focus today is really looking at the income protection area, because that's the one that is going to really impact our clients immediately, and it is certainly the product that APRA, the Australian Prudential Regulatory Authority, has earmarked as the one that they're really looking closely at. So why this is important is that, insurance is one of the major pillars of the financial and economic stability. And if there's no insurance available or insurance isn't sustainable, it means that people are less prepared to take risks, and that has a flow-on effect to the economy as a whole. And so it is seen as a serious risk to stability if the insurance industry is making billions of dollars worth of losses on one particular product. So they are really wanting, the government's wanting to see the insurance companies do things, take action, increase premiums, change terms and conditions, and they're going to ask them to actually report back in mid-2021 on the changes that each company has implemented. So this is really the reason why these increases are coming, because the insurance companies now need to be more able to demonstrate that the premiums they're collecting will meet the claims that are being made. And look, the obvious question is, will I be stuck with the increase? Well, is there anything I can do about it? Well, really, you've got three choices. So do nothing, pay the increase, stay with your current insurer. You can change insurers, or you can modify your current policy if a premium increase is unsustainable for your personal household budget. If you've got surplus cash flow and the premium increase is bearable, then there might be really good reasons as to why you might continue with your policy, and we'll cover some of those in a moment. But the sorts of things you can do to keep the premium the same without changing insurance companies is to change the waiting period on your income protection. Now, I'm not making a recommendation that you do this. I'm just flagging it. It is one thing you can do. So you could change a waiting period. If you've got a 30-day waiting period before you can receive a claim, you could change it to 90. If you've got lots of sick leave, you could change it to 180 days or 6 months. Or if you've got really good money built up in your offset account and you're traveling well financially and your partner works, you could even change your waiting period to a year. Noting that most income protection policies will actually pay you a benefit during the waiting period if you go to hospital for more than 4 days. That if you've got the right kind of policy, there is a benefit that can be paid without having to wait the full year. So changing your waiting period is one thing to look at. You could also change the benefit period. The benefit period is how long the insurance company will pay you when you are successfully accepted for your claim. So typically you can have a maximum of 2 years, a maximum of 5 years, or if you had something really serious and you couldn't return to work, you could be paid from when you claimed until age 55 or even to age 65. So you could actually reduce your benefit period from 65 to 55, or you could come down to a 5-year benefit period. So again, this is an option that really significantly impacts the price of your income protection policy. The other thing you could do is decrease the amount that you're insured for. It's very important to look carefully at this before you do it. But again, if your circumstances are such that you have paid off your home loan, your partner is working, you might say, look, really what we need is, half this amount of money. It wouldn't be perfect, but we would be okay because we can't sustain that premium increase. Or you could do a combination of all of those things to keep your premium the same. And everybody's circumstances will be slightly different as to what combination of those things you might choose. So there's lots to think about for sure. You're definitely not just stuck with the increase your insurer mails out to you. And Jo, there's lots to be aware of. Maybe you'd like to share some, our views on this tricky part of the whole thing.
So, we've spent a lot of time with our clients historically getting them in the right policy. So with, the bespoke and correct terms and conditions of different contracts, group life insurances and definitions of occupations. So, beware and get some advice around some of the things that you might not immediately think of. So if we do go with a new provider, what might happen, it might be a sweet spot to get you in for the first year, but what will they do in the second and the third and the fourth and fifth year? Coming off the back of what's been a very difficult year health-wise and globally, we have seen some new policies, particularly for frontline health workers, where pandemic exclusions are applied. So again, being really aware of what particular insurance companies are prepared to underwrite and cover or not cover. Agreed value contracts. So, we spend a lot of time giving that certainty and security to our clients that they have contracts where if you were in the unfortunate situation of claiming, that what you've been paying premiums for, you will be covered for. So despite, what your pre-disability earnings are. So, again, this is the devil in the detail, agreed value contracts versus what we can get these days, which are simply indemnity contracts. Now, look, there are some great definitions out there for indemnity contracts, but it's really understanding that detail and how it applies to you that's important. Something else that's quite tricky and important to be aware of is waiting periods restart. So, having had insurance for a number of years, you've served all your waiting periods and you're covered. So being aware that a change may trigger or restart a waiting period before you could claim on certain conditions. And, if your health is changed, sometimes our health changes for the better and sometimes it goes the other way. So again, being able to have that conversation and foresight when we make these potential changes is very important.
Yeah, and the waiting periods that Joe's talking about are quite obscure things. For example, I mean, it's not something we want to see happen to any of our colleagues, family or friends, but, suicide is it's a rising problem. And if you change insurers, you'll have 13 months to wait if you had some terrible thing happen to you and you did suicide. You might find, or your family might find, that there's no benefits, or if you have any serious illness or implications from something like that. The other thing that's a really important, again, obscure thing, is in the insurance industry a number of years ago, the government introduced some regulation that forces insurance companies to accept that if somebody doesn't disclose something about their health or their circumstances for a 3-year period, up to a 3-year period, if it's a material non-disclosure and you claim and the insurance company becomes aware of it, they can actually not pay you, or they can vary your terms and conditions, or they can cancel your policy. After 3 years of paying premiums, they cannot do that. The only time they can cancel a policy is for fraudulent non-disclosure of facts. So if you've had a policy more than 3 years and you go cancel it and get a new one, this little obscure waiting period of 3 years starts again. So there are some things to be very careful about when you do change insurers. And look, a lot of our clients are frontline health workers, and to not be covered with a new policy for a pandemic, and we don't really know how the virus is going to mutate and play out, and whether we might even have future pandemics. To not actually have cover for that as a health worker would be a terrible outcome of what is essentially the government asking the insurance industry to look at how it prices things. We wouldn't want the fallout to be something terrible like, not have cover. So it's definitely a little bit of a minefield. And there are other changes foreshadowed. So, there has been a lot of discussion around not being able to issue guaranteed renewable contracts. Now, what that means is once an insurance company issues a contract for income protection with one of our clients, the only way it can be cancelled is by our client not paying the premiums or writing in and saying, I don't want this policy anymore. The insurance company can't cancel it on you. So they're talking about potentially not allowing guaranteed renewable contracts. They're also talking about a 6-month benefit cap, stricter disability definitions to exclude claims, maybe 5-year renewable maximum terms, which means every 5 years you might have to provide financial evidence or maybe even medical evidence to continue to renew your policy. These are all things that are being talked about. Now, if you have a current income protection policy contract with an insurance company, they must honour the terms and conditions of that contract. They cannot change that contract with you. But if you don't have an income protection policy and you do need one, I would suggest that this is now a really super important time to get your policy in place before some of these other changes do come in and it's not possible for you to acquire the type of comprehensive cover that, as a medical professional earning a large income over time, it's essential. Your income is the thing that gives you the life that you want. So very controversial changes foreshadowed there. And as Joe mentioned earlier, we are a life insurance broker. We have access to all the insurance companies in the marketplace. We have fantastic research on those insurance products. And we're going to put things in front of our clients that we know will take care of you and still meet your goals and objectives. And as part of a review, and a regular review, we're addressing this particular aspect of changes to insurance. We are looking to speak to or communicate with all of our clients that have insurance policies that are renewing. So on your annual renewal with the company, 60 days beforehand, you'll get notice, because they have a contractual obligation to give you a certain amount of notice on changes to premiums. So on your policy anniversary, you'll get notice that your premium is changing. And we're looking to speak to and communicate to all of our clients between now and the end of March. And then on review, we'll be looking at what is the policy you have, should you keep it, should you accept the increase in premium when that comes to you, even if it's going to be 38%, because there might be mitigating factors that we've already sort of just touched on in this the webinar. So I think one of the most important things that comes to mind here, and Joe and I talk about this all the time, our clients are amazing. They're looking after everybody else, and our job is to be looking after this kind of detail for our clients. So if you don't have an advisor, who's looking after you? Who's going to help you make the right decisions through this little tricky set of circumstances at the moment? And there's, future changes are foreshadowed. So there will be things continuing to happen in this space. So, we'll be keeping informed and on top of those future changes, and we'll be helping our clients to understand those changes as they arise as well. So I think what we really wanted to do today was to give you a bit of a feel for what is happening, just set you up so that you know that these renewals will be coming to you from the insurance companies, and they will be for increased premiums, and that we're here to help. We'll do great analysis for you and put you in a position to make a really good decision. Obviously, we're here. You can call us, pop over and have a coffee. We're just across the road from the Sunshine Coast Hospital in the Pulse building downstairs. We'd love to talk with you about the challenges that you might face around this and other things financial. So we'd invite you to call us or email us at info@wealthmed.com.au and take the opportunity to catch up with us. I guess one thing that's super important to us is that we give back, and we always love to give a little plug to our fabulous charities that we support, Wishlist and Sunny Kids, and we're just right here and happy to help you if you need help. Thank you for watching the webinar today. Joe, is anything else you'd like to add?
Carolyn, here for a chat and to help where we can.
Great. Okay. Well, thank you for watching, and we'd encourage you to pass this webinar link on to your friends and colleagues who may not be aware of what's happening in this space. We look forward to seeing you around the hospital sometime soon.